Hello, this is Jed Brewer with Study Groups in the Below the Line Club. It's really nice to have you on this call on this summer day in July. We're going to talk about health insurance and how do we demystify health insurance today. So employee benefits are something that is challenging for most all of our firms. We tend to be very lean operations. We're trying to run our actual operations, and now we're tasked with trying to figure out what is the right or best healthcare plan for our companies. And that's far afield often from the core operations of our business. So it's really helpful when we can have people that can speak into this for us. And Ty Franklin is the Senior Consultant and Actuary at Alera Group. And so very excited to have Ty on this call to help demystify health insurance for us. A little bit of a background about Ty. He's out of Omaha, Nebraska area. I was introduced to him through one of our study group members that have worked with him, Sapp Brothers, based in Omaha area. But Ty has been involved in the healthcare industry for 15 years. The majority of that time he was an actuary at Milliman, and he's been with Alera Group now for 2 years. He's a Health Rosetta advisor, and we all have our own kind of like personal goals that we want to do, especially as it relates to profession in our lives. And I found it interesting for Ty. He's got his BHAG, which you're familiar with that term, big, hairy, audacious goal, but that's to increase life expectancy by 5 years for the people that he gets to work with. So I find that a very admirable goal that he has. But Ty, thank you for being on the call here with us today. Just for the audience, a little bit of housekeeping ground rules. I've got you muted. We don't want to pick up background noise. However, we want this to be as educational as possible for you, and we'd love for you to have the opportunity to ask questions. So if you do have a question, please type it into the GoToWebinar dialog box that's on your screen. I'll be able to see those questions, and I'll relay them on to Ty at an appropriate time. But again, we want this to be educational for you and to be able to get your questions answered on this very complex topic of health insurance. So with that introduction in play, Ty, demystify health insurance for us, please.
Thank you, Jed. And yeah, I will try my best. The health insurance industry is a bear, but we're going to pick away at a couple of different things. So getting started, just want to lay the groundwork of where we're going. So 3 primary things, transitions that we're going to look through buckets. The first is, what is the current state of the American healthcare system? 2 is break down insurance in certain capacities, exploring, the difference between fully insured, level funded, self-insured, different funding mechanisms or methods, and then also dive into what is bundled and unbundled, if you aren't familiar with that. And then the last thing we want to do is round out the conversation by giving you 3 things to consider for your upcoming renewal. So with that
sounds really good.
We will dive in with the current state of healthcare. And Houston, we have a problem. In the next few slides, we're going to talk about a variety of different things from a macro level all the way down to a micro level, and how you and I as members engage the system. And so without further ado, this is what the current state of American healthcare looks like. It's a black box. And to help us today, I have my own black box. And hopefully you can hear a little bit of rattling in there. I'll tell you, physically there are things in here, and to help us, we're going to open up the box and look into a variety of different things in the next few minutes. So our first thing that I'm going to pull out is a calculator. And how does that relate? Where is this going out? It's unsustainable. If you crunch the numbers and you look at a longitudinal study of where we started and where we're going, it's not looking very great. So here is a slide looking at multiple countries over the last 3+ decades, starting in 1980 there on the left side, and rounding out in 2021 with that most recent information. And I kind of highlighted some boxes there for us. And you can see on the left side of the graph, when we started in 1980, it was fairly tight. There's definitely that middle of the pack where there's a lot, and then you have your low entrant there, which is New Zealand, and then at the top of that line was America, the U.S. But as time goes on, there just continued to be a greater differential or disparity, and obviously ending there on the right with the U.S. in 2021 being the percent of GDP spent on healthcare at just under 18%. You compare that with the like country average of 9.6% there. So almost double in that time frame. And, if we continue to project this out, where is that going to go? So that's one component of our current health system and where we're at. Next,
and Ty, I would say that some people would be very happy with paying a lot of money, in this case 18% of GDP, if we were getting really good outcomes for that. But I think what you would tell us is, our outcomes aren't any better, in some cases worse than other comparative countries.
That's exactly spot on. And you're 2 slides ahead of me. We will get into that, but yes, you're right on. And that's the question is, if we are paying, are we getting the return on that investment? So we'll pit stop with my next little clue, which is a $500,000 bill from the game of life. And how does that relate to our current state of healthcare? And it's geared towards the insurance carriers. So the insurance carriers are one of the primary means in which participants like you and I get health insurance. And it's working exactly how it's supposed to. So how is it working? Right here, we're going to look at the four major insurance carriers in the U.S. today and their stock returns in the last 5 years. And this is, dated from a couple months ago here in April. But first, we have CVS, which is Aetna. So Aetna was purchased by CVS. That's maybe even a little hint as to where we're going. We have a PBM, a pharmacy benefit manager, CVS, that has purchased a health insurer. So I'll drop that hint there, and we'll maybe revisit that later in the discussion. But their 5-year return is 28%. So fairly modest. You divide that by 5, roughly a little over 5% year over year, probably below the market. But that's one of them. Our next one is Elevance, which is also, you would be better known as the Blue Cross Blue Shield network. Their 5-year return is hitting triple digits there, right around 100%. Third, we have United Healthcare, United Health Group. They're at 105. And rounding out our big 4 carriers is Cigna, which is just under 120% over the last 5 years. So we know that our percent of GDP has increased. We know that the insurance carriers are doing well. And they're doing what they're supposed to. They're publicly traded companies. They're driving shareholder value. So that kind of makes us want to think or consider what are the incentives, and is patient care the number one incentive in that? And then the last thing, just in light of that, driving shareholder, the CEOs of these companies, and here we're capturing a couple more than just the 4 that we highlighted, but the 7 health insurance CEOs made just over $330 million in 2022 alone. So again, they're doing their job, they're driving shareholder value, and being rewarded for that handsomely. Now, Jed, to get to our next spot is, are we getting what we're paying for? So we've seen the increase of GDP, we've seen the insurance carriers are performing well, so are we getting what we're paying for? And I have a toy kit of Band-Aids that would maybe indicate that we're not quite there. So this chart is going to look at, there's a couple different things I'll highlight. The life expectancy is right there in the center. The health spending per capita is to the right. And then on that left side, we have our country. So again, comparative to other developed countries where we're at. So we have life expectancy. America, the United States is at 77.5 years. And compared to those like countries, we are, a couple of years below that, with the average. So that blue line right here, that 82.2 is the comparable country average. So we're about 5 years below that. And then even if you compare to Japan, which is the top at the bottom there, they're at 84. So, roughly 7 years below Japan. And then on the healthcare spending per capita, so this is, again, looking at dollars, investment, slightly different than percentage GDP and the insurance carriers' profits, but we are far exceeding the amount that we're investing per capita. You can see that at just over $12,500. that comparable spend per capita is 6,600 and change. So we're roughly twice as much in investment dollars, but we're getting a 5-year less return on that. Next, I have a magnifying glass. So what kind of goes into all of this? And we're going to take a deeper look at some of the pricing. And there's 4 different examples that we're going to look at. And one of the things that goes on that is really hard for us as just normal consumers in the market is to know what the cost of care is at hospital ABC versus facility XYZ. And so in 2020, 2021, there was a new legislation passed called the Consolidated Appropriations Act. And part of that was that hospitals needed to start to share and be transparent on what their prices are with different carriers and different networks. And so these next few slides are going to look at some of those different data splices. This first example is looking at the same carrier with different hospitals. So the specific procedure is a hip replacement surgery. We have 3 different providers. We have a large hospital system in the Omaha area. Then we have 2 independent surgical centers as provider B and provider C, and then we have the price listed there. So same hip replacement surgery, varying by 4 times, depending if you went to the hospital system at $42,000 or the independent surgical center just under $10,000. So this is one example. Next, let's, a prompting question for us. How do we know which provider to see? So I have my insurance card. I don't have these prices listed before I go and choose hospital or provider A, provider B, or provider C. So that's part of the disconnect in terms of, confusion and getting quality care at affordable prices.
And I'll say, Ty, I feel like that's one of the biggest headaches or frustrations that I hear voiced is I have no idea what something costs. I go in, I get it done. Maybe I was referred there from my general practitioner, and then I get a bill later in the mail, and I have no idea what it's for, if it's the right bill or whatnot. But it just feels, like you said, very untransparent.
Yeah. You're exactly right. This is one of the only good, this not the only good, that it's a service that we purchase and receive without knowing the cost up front until the medical facility processes that downstream. And another thing to kind of hit on there too is, where is the navigation coming from? It's probably from your doctor that says, hey, we need to go get your hip replaced. And what are their incentives? Again, I'm not throwing shade or just the reality is if I work for a hospital system, I'm most likely going to refer that person to somebody within my 4 walls. And, so if I went to provider A to get my diagnostic work done, they're most likely going to refer me to somebody within their hospital system. And that's just kind of the way of the world. And so, spot on. Our next price discrepancy that we want to examine with our magnifying glass is looking at the same hospital, but with different carriers this time. So different procedure code. We're looking at a sleep study, all being conducted within hospital, de-identified hospital W, which is, again, a major hospital system here in the Omaha area. But we have 3 different carriers at play. So let's just, for example, say it was Aetna, Cigna, and Blue Cross or Elevant. So those are your 3 different carriers there. And again, you're just seeing widely different costs for the same procedure, but it's dictated based on which insurance carrier you're with. So our prompting question there is, can we all get carrier 3's price? That would be great, but that's not how negotiated networks and the finances go. Our third example here in the price discrepancy kind of realm is looking at the same carrier now at the same hospital. So you would think, just based on that outlay, same carrier, Blue Cross, at the same hospital, doesn't matter what the procedure is, it should be the same price. And here for, again, a different procedure, we're looking at a mammogram this time. It's that same major carrier. You can kind of see that highlighted here. But what also happens behind the scenes is that different carriers of Blue Cross, Cigna, Aetna have different networks. So they have a big, broad, all access, and then they have narrow networks. And those different networks and negotiated rates dictate or create these different tiers of pricing. And so, same insurer, why are there 3 different prices? And as I mentioned, it's because of those different networks, broad, all open access versus narrow access, and trying to draw steerage. But when you see the price variance there, it kind of makes you want to scratch your head a little bit. Our fourth and final example of kind of what's behind the scenes when it comes to prices and not being able to have direct line of sight is a prescription drug example. Some of you may have heard earlier this year about the J&J lawsuit where Johnson & Johnson employees sued their own health plan around, and this is kind of driven from that same Consolidated Appropriations Act that I mentioned a couple slides ago that was interjected in 2020, 2021, to where there's a greater fiduciary responsibility on employers to be prudent in how they're purchasing and acquiring healthcare. And so in this specific lawsuit, it was focused and centered around pharmacy drug acquisition. And you can see there's 2 drugs kind of highlighted here. One is an HIV drug, which the health plan, Johnson & Johnson's health plan, purchased or got a 90-day fill for just over $1,600, but the cost to the pharmacy was around $180. Likewise, or similarly, there's a different drug for multiple sclerosis, which the Johnson & Johnson health plan paid just over $10,000 for, but it typically costs no more than $77 out of pocket. All right, so we're going to move on to our next kind of current state, and I have a book with me to talk about education. So how is the current state of health insurance related to members like you and I engaging the plans that we're buying? And so I would actually say there's maybe a miseducation. There was a survey done by Policy Genius a couple of years ago that found that only 4% of Americans surveyed knew the 4 basic insurance terms that are in 100% of our health plans, which are the deductible, the copay, the coinsurance, and out-of-pocket maximum. So this lack of understanding or not being able to navigate is contributing to either people not going to the doctor when they need to, or not understanding how to be consumers in their current space. And this all kind of culminates, again, we're drilling down more and more from that macro GDP to individual costs in our local markets to how you and I understand insurance terms. And our last one is, I got a little bit ahead of myself. I'll go back 1 slide. I have a credit card or a debit card. And how is this personally impacting or creating financial burden? And so while we pay thousands of dollars every year for health insurance coverage, the reality is that a lot of people are functionally uninsured. Our first statistic here from Gallup says that 38% of Americans or a family member have put off medical treatment due to financial concerns. So we're paying thousands of dollars to have health insurance, but when we're actually engaging, 4 out of 10 people aren't going because they're concerned about the cost. Next, we have a stat here from SecureSave that says...
And real quick, I'm concerned about the cost, I would assume, because we've got to pay our deductible or co-insurance, even though we have catastrophic insurance or whatever plan we may have, but it's that aspect that puts us off, right? Yep, exactly. And in the last decade, 15 years, there's been an increasing number of high deductible health plans that have been introduced to the market and that employers have taken on. And in those situations, right, employees or members they're paying that first dollar for all services until they hit their deductible or out-of-pocket maximum. And so an office visit costs $150 to $250. And yeah, you're staring, do I go get this checked out or do I wait a couple more days and see if it resolves itself? Our second statistic here is 63% of employees are unable to cover a $500 emergency. So hence why we have a credit card. And
things are being put on that, and debt is continuing to increase just at large in the United States.
And it almost feels like a $5 emergency is an office visit to a general practitioner now. I don't know what it's usually $300 plus to just have a regular office visit, a well check.
Yep, for sure. And then you even think about what an urgent care or an ER visit is, and that's, a multiple of that $300. So our third statistic here from the Kaiser Family Foundation says that 41% of adults are carrying some sort of healthcare debt, based on a definition of credit cards or money owed to other family members. And what's, again, our last little bit here that I'll mention is what's kind of contributing to that is that out-of-pocket maximum that our plan designs are around. So here from Milliman's mid-market survey, the median out-of-pocket for 2023, not 2023, PPO plan was $5,000. The last thing I'll mention, just another quote or another statistic from Milliman. They come out with an annual medical index. They project in 2024 the cost of healthcare for a family of four is $32,000 and change, $32,066. And for an average American, it is $7,000 and change. No, I shouldn't have done that. I was trying to see, my screen is a little blocked when I look at, there we go. But it was 77, roughly 77 and change.
That's for the typical person. Yeah.
For just an average, yeah, correct.
And that's all in. That's insured plus uninsured, just the cost to society for a typical person, healthcare.
Correct. Yeah. All right. So these handful kind of round out the current state of American healthcare. If we were to draw some summary statistics or thoughts, is costs are continuing to increase at an unsustainable pace. Part of the contributing factors there is it's hard for individuals like you and I to navigate the system. The health plans that we have are complicated and confusing, and it's increasing financial burden on employees, on our neighbors, on our families. So let's transition then to an insurance breakdown. So imagine on the call today, there's a wide variety of people with experience and exposure, and we don't know what we don't know. So we're going to take some time to drill into different funding mechanisms, primarily fully insured, level funded, and self-funded, and then also look at a nuance within that system called bundled and unbundled. So we're going to be parked here for a couple of minutes as we unpack the different insurance funding models. The first one that we'll discuss is a fully insured structure, and that's where you are signing a 12-month fixed cost premium. Now, obviously, if enrollment ebbs and flows, it's going to change, but at large, you have known plans and known premiums, and that's what the expense is for that 12-month period. That fully insured premiums are going to be based on expected claims or expected costs, which incorporate the paid claims and the fixed cost, administration, reinsurance, things of that nature. And there's this dashed line here, which is going to be our maximum liability. So again, known rates for 12 months, you pay it. It doesn't matter if claims are 200% of expected or 50%. You have a known expense there. Our next funding model is what's called level funded, and it's kind of a hybrid between fully insured and self-funded, where you still have your fixed cost layer here. So the administration costs, the reinsurance costs are going to be in here, but the claims component is somewhat variable. And there's two things. There's the max liability, so you are capped, but if claims come in below this, you're sharing risk with the provider of the health plan. So if claims come in below, you could potentially get a refund for the positive claims experience. And then our last
on the difference between level funded and fully insured, why wouldn't somebody choose level funded versus fully insured if you have the opportunity to get some of your claim back? Is it because it's more expensive for level funded per equal max liabilities?
Yeah, no, it's a great question. I'm going to answer. There's a lot of nuance and detail behind this. So some of the things that go into that is not level funded products aren't guaranteed issue or guaranteed renewable. So you have to submit underwriting either on an individual basis or have previous experience that an insurance carrier is going to review and say, hey, you're a good risk. We'll enter into this shared risk arrangement with you. But if you have maybe some high claims or a lot of pre-existing conditions, those carriers may just deny a quote. So you're not guaranteed coverage in a level funded arrangement. It's really kind of only open to markets or employers that have enough size or good inherent risk with them. But if you qualify for that or meet some of those requirements, then it's 100% something that should be evaluated on an every year basis. Yeah. Great question. Our last funding arrangement or model is what's called self-funded. And this is where you as the employer take on the primary risk and responsibility. I kind of hesitate to use the word risk because my next slide talks about risk a little bit. But you are funding all the claims. So you set an annual budget. Our annual budget was set at this dashed line. And if claims come in above that, you need to write the check for the deficit or what was overspent. But in the case that claims come in below the expected or the budget, then you get to be the 100% recipient of that good experience. And so to kind of illustrate that a little bit more, we have a couple of scenarios here. So what happens in any given year if we have really high claims? So under the fully insured arrangement, you have your max liability as a company, the insurance carrier is picking up the loss. In a level funded arrangement, very similar, you have your max liability, the insurance carrier is picking up the difference or deficit here. And then in the self-funded, you as the employer are covering that change or that delta, that difference. So that's what happens this year. Another question to ask though is what happens at renewal? So if we have a really bad claims experience year, under the fully insured arrangement, there's going to be a high increase, a high renewal. Insurance carriers aren't in the market of losing money and giving, charity. And so you're probably going to see a higher double-digit above trend type of renewal for that year of bad experience. Probably a similar story on that level funded. And because we went into some of the nuance there, Jed, there's the potential that you could be denied a level funded quote and you might have to jump back into the fully insured marketplace. But then under the self-funded arrangement, you have a lot more autonomy, you have a lot more flexibility, and you're going to have your own independent analysis to say, hey, was this high claims year an anomaly, or is it an indication of what's to come? And you're going to work to create your own budget for the next year. And because you're self-funded, you can also purchase and acquire different things. You can be more proactive to try and lower those claims that you can shrink and have more control on the next year's renewal. Our next scenario is what happens if
before you move into the last one on the level funded from the audience, they were just saying, if you're not guaranteed in a level funded program to be renewed, is that the company possibly not being renewed, or is it certain individuals within the company that may be excluded?
Great question. It would be the entire company plan. So it might be one or two individuals that maybe spiked the claims, a high cost claim, a specialty drug, but it's the entire health plan or the entire group that's underwritten together.
Makes sense, yeah.
Yep. All right, our next scenario here is what happens if low claims come in. So under that fully insured funding model, your fixed costs are 100% known. The insurance carrier gets to receive the benefit of claims coming in below expected. So there's kind of lost dollars in that sense. And the level funded, because it's that hybrid, you would, and it's a shared risk arrangement, you and the insurance carrier would share in a negotiated term. It's not always 50-50. It could be 75-25. There's a lot of different ways that can be split, but you would be able to share in the positive experience and low claims from that year. And then in the self-funded arrangement, you get 100% of what was below budget. So that kind of, outlines what happens this year. What happens at renewal is maybe, I would say this is a rarity, the fully insured carrier might say, hey, we're going to decrease your premium. It's happened before. You on the line may have experienced that. I do know in 2020, 2021, with COVID and, some of just health claims going down because of lack of utilization, there were credits and rebates kind of given and flat renewals, but obviously that was, a unique event. But in any normal setting, when you have a low claim, your fully insured renewal is most likely going to be a trend renewal. And the level funded, you should get credit for the lower claims and probably have a little bit more negotiating power. And then in that self-funded arrangement, what happens at renewal is you get to take that into consideration again, where you project what budgeted claims are going to be for the next year and set those. So again, you're more autonomous, you're more in control, and you get to reap the benefits of taking on the volatility of claims. The last thing I'll just kind of interject into this slide, and I know we spent some time here at length, but understanding the few different models is super important, and it's going to set up the next few slides. And as you are a benefits coordinator or responsible for some of those decisions, being well informed of kind of how it operates is super important. But how does this play out over multiple years? So as we mentioned, in the fully insured context, even in good years, you're probably seeing a trend increase. In the bad years, you're going to get hit for that because the insurance carrier just paid out a bunch of claims on your behalf. In the level funded, there's more ebbs and flows. Again, you're going to receive some of that credit for the low claims, and obviously you share in that risk. But in that self-insured, there's obviously more volatility because you don't have that up top protection. And I'll make a small plug here that you're not completely out on your own. One of the things of building a self-funded plan is incorporating reinsurance at the appropriate level, which would be catastrophic coverage for either specific individuals, which is called individual stop loss, or aggregate stop loss, where it's just looking at total claims on a 12-month basis. Does it exceed certain thresholds, usually 125% of expected? So you're not completely left out to cover $1 million hemophiliac claim or premature baby that may hit the plan. But there's some fluctuation with just the volatility of plans. And, when you're setting a budget, the goal is always to set it at expected. And so that means 50% of the time you should anticipate claims coming in above, and 50% of the time you should expect claims to come in below.
Ty, does firm size play a factor in which bucket may be best for you? I feel like most firms are in fully insured, and then as they get to larger to some certain level, then they start to move towards a self-funded program or a captive of some kind. But give me a sense of when it makes sense.
Yeah. You're very attuned to what's going on. I would say smaller groups for sure are starting here in the fully insured, and then again, with good experience, get into that level funded. I was just talking to a colleague the other day who has a 7-life group that's in the level funded space. So you can get down to that level funded at pretty low numbers. And then inversely, you also see 100-life groups that are in the fully insured space. I would say, around 50 is when I would definitely be looking at level funded, even to the self-funded. And another thing that's very interesting about the marketplace right now is that there's, with predictive analytics and artificial intelligence, there's all of that's being applied to the health insurance and underwriting world as well. And so you are seeing some new reinsurers on the leading technology side of things start to quote groups that are, below that 50-25 life threshold. So great question and good context to add here. All right, so the last thing I'll kind of mention related to just risk before we talk about bundled and unbundled is if you're fully insured, level funded, or self-funded, does the risk change? And what I mean by that is here's a sample company risk profile where, their age gender composition is 1.143, so about 14.3% greater than the national 1.0 average. Their area factor, so where their employees are located, are in a roughly 12% higher cost geography. The coverage tier is kind of reflective of, are we covering more dependents? Are those children? Are those spouses? Because there's different risk profiles associated with each one of those. And then just the total. And the reality is that your company risk profile based on these few factors is the same whether you're fully insured, level funded, or self-funded. Now, the actual application of claims and, accidents, broken arms, all of that stuff kind of dictates the claims, but the underlying risk profile is the same. And so it's important to kind of be mindful of that. And what matters is how you purchase and acquire that care. So under the fully insured, level funded, you're kind of purchasing and acquiring it through that health insurer. Under that self-funded arrangement, you are in more control to say, hey, we're going to do direct contracts, or we're going to implement direct primary care. And I'm throwing a couple of newer terms in there, but you get to determine and just have a lot more flexibility there. So that is where in the purchasing and acquiring of care, where you can actually have the same risk profile, but impact the cost on the back end.
It's interesting on the last slide that you just had here, but your risk profile. So age, that's for me, I think a simple one. Like the older you get from an actuarial perspective, on average, the more expensive it is, more likely to have claims. I see you have gender on here as well. Is a particular gender tend to be more expensive? Does it vary at different points in age as we think about our own company and risk?
Yep, it does. It does. If you're really interested, I'm sure you can Google search. I know that there are age, gender risk tables that can be found on the World Wide Web. But what you'll see is typically adult females will be more risky, 18 through 45, kind of in those child rearing ages. And then it kind of flips to where on the back end, males become more risky and higher cost as they get older. Yeah,
makes sense. Yeah.
All right, we're rounding out here with bundled and unbundled. So we've talked about fully insured, level funded, and self-funded. And within all three of those different arrangements, you can have a bundled or an unbundled vendor stack. And what I mean by that is bundled is you have everything is vertically integrated. We're trying to represent that here by the same color blue here. And any health plan is going to incorporate these different components. You have a medical network. Where am I going to go see a doctor, a specialist, get surgery? You have a pharmacy benefit manager who is responsible for filling prescription drugs. You have a third-party administrator who's taking in payments, paying out payments. You have the reinsurance, which we briefly talked about. So every health plan is going to incorporate that. And then there's a variety of other things that can kind of be thrown in here. Do note that this is not drawn to scale. It's just nice to have it uniform in size. But in this vertical integration, you have the same parent company that operates all areas of this health plan. So if you're with the Blue Cross, you have a Blue Cross network with the Blue Cross PBM. The Blue Cross is the administrator, Blue Cross is the reinsurer, and any other programs associated with the health plan. In an unbundled situation, each component can be individually shopped and acquired. So you can have a Blue Cross medical network, but you can go find your own independent boutique pharmacy benefit manager. You can have an independent third-party administrator. as we just talked about, there's a variety and more reinsurers entering the space. And then any other programs that you want to kind of round out your benefit plan with can be individually shopped. And so this kind of creates a little bit more of a free market capitalism structure, because you can individually shop and compare and contrast and negotiate. When you're in that bundled arrangement, you don't get to say, hey, we don't like the reinsurance rates that you're giving us. You're kind of handcuffed in that way. All right, so taking our 3 different funding methods, adding in that bundled, unbundled arrangement, what are some different options? And so we'll get through this one pretty quick. But in that fully insured space, you can have a BUCA plan, and BUCA up here stands for Blue Cross, United, Cigna, Aetna, so your 4 major carriers. You can get a fully insured plan through an association, or you can find an alternative unbundled solution where, again, you have that same 100% fixed cost arrangement for that 12-month period, but that's out there. Level funded, very similar. You have the BUCA option, you have an association option, you have an alternative unbundled solution out there. In the self-funded space, you can have a BUCA plan that is bundled or unbundled. So as I mentioned on that previous slide, you can have that Blue Cross network, that Cigna network, that Aetna network, but then still have a different PBM or an independent third-party administrator kind of involved. And then in your alternatives, you have this completely unbundled with a non-BUCA medical network. And then there's 2 other kind of funding strategies out there called reference-based pricing and direct contracting. And for time's sake and today's sake, we won't get into that, but just, again, I'm wanting to give a good lay of the land of no matter where you're at on the spectrum, exploring fully insured or level funded, even within any one of these individual buckets, there's multiple things that can be vetted and researched. The last bit is kind of what I would deem just non-insurance benefits. Direct primary care, I think I threw that word in there a couple of slides ago, but this is something that is not necessarily insurance, but it's a subscription-based type of care, and we could have a whole 45-minute discussion on direct primary care, but know that that's out there, and especially for groups that are under 50 lives and aren't required to offer full comprehensive health care. Direct primary care, if it's available in your market, can be a really rich, affordable benefit to members, because primary care is, roughly, there's a lot of statistics out there. I edge on the side of conservatism, but primary care can cover 70 to 80% of most medical needs. And so at $100 a month per employee per month, you can have that type of coverage and access without paying, the hundreds of dollars or thousands of dollars that full health comprehensive coverage would be. Virtual primary care is an adaptation of direct primary care, but in the virtual setting, those are usually a little bit cheaper. Health shares, so there's health share ministries, there's other ones that are kind of aggregation of risk, but again, those aren't health insurance, and they operate and function a little bit different, but something to have on your radar depending where you're at. And then an HRA is a health reimbursement arrangement. And I'm listing 2 here. There's a couple of other different health reimbursement arrangements out there, but it's kind of where you're reimbursing individuals for healthcare costs or insurance premiums. ICHRA is going to be one that you're probably going to hear more and more about in the coming years. It was newer legislation here a couple of years ago. So just have that on your radar.
I remember hearing an ICHRA the best idea at a study group meeting, and it ended up being the winning best idea, but the member really enjoyed it. I'm going to misquote it, but I feel like what he was saying was it allowed him to get out of having to choose plans for his employees, that they could choose their own plan, a single plan, I should say, or a good, better, best, but he could kind of pay for them to choose the plan that best met their individual family's needs.
You're a good listener and a good learner. That's a good summary of what's happening in that space. It's primarily where a company will say, hey, we're going to stop offering the plan designs that we have decided, and we're just going to seed a health reimbursement arrangement fund for you. Say it's $6,000 a year per employee, and then that just becomes a known expense. $500 a month per employee, that's dollars for them to then go out to the individual marketplace and find a plan, good, better, best, Blue Cross, United, whatever carriers, represented in their individual state, and get coverage. The couple of things that I'm a little bit wary of in that regard is one thing is in the individual market, if I were to go out there without an ICHRA, you, depending on your salary, depending on the size of your family and income, you can qualify for you can qualify for tax subsidies and credits from the government. In an ICHRA arrangement, nobody can qualify for those. And so that's one of the downfalls as of right now, kind of the way the legislation is set up, is that even if you were to give an individual $500 a month to go get their individual coverage, if they qualified for more than $500 without the ICHRA, like say $1,000, they were getting a subsidy or a tax credit from the government, they would kind of be net negative in that situation. The other thing, and again, there are a lot of ICHRA vendors entering the space, and a majority of those vendors do give navigation to employees, but giving somebody $500 a month and then saying, hey, go find your own health insurance can be kind of an overwhelming task, just given how many options are out there. And so if you do explore that, definitely want to encourage having concierge navigation to help members select plans. And again, that's I'd say a pretty common service with most ICHRA vendors.
That makes sense. And just looking at the chart there, you got a lot of different options that one can choose from. Should your broker be helping guide you to, hey, it's best for you to be in fully insured and self-insured, and particularly around the unbundled? I hear less conversation around, I've moved into an unbundled option. There's a lot of different moving pieces within there that could possibly be negotiated. Who should be leading that charge for you?
Yeah, your broker, advisor, consultant should be engaging that and bringing some of these solutions to you for sure. Yeah. I will say what can be hard, though, is it requires more work, right? If I'm going to go quote all of the different BUCAs and go look at an association, and it becomes more work for that advisor to do versus, hey, we got a trend renewal. It's easy enough. Let's go on to the next year. So you have to kind of guard against that a little bit and be mindful of that. And right, wrong, or indifferent, a lot of how brokers and consultants gets paid are by the insurance carriers, right? If I have a client in a fully insured Blue Cross arrangement, I'm getting a % of that premium. And the more business you have with the carrier, the more bonuses on the back end you could potentially be receiving. And so if I move this Blue Cross client to an alternative unbundled arrangement, I'm going to lose out on some compensation potentially. And so having really transparent broker advisor relationships, I think is important in knowing where the money is and where it's going. So, even to that point, to draw that out a little bit more, if you've been with the same insurer in a fully insured arrangement for multiple years, it might be worth asking your advisor to explore a couple of other ones to do a market check. And even that market check every couple of years is a worthwhile endeavor to kind of prove that you're taking on your fiduciary responsibility as the CAA is kind of injected into the space. All right. Very good discussion. I'm doing a quick time check. We're at 49, so we're on the downhill. So considerations for your upcoming renewal. It's worth a try. So one, obviously we spent a handful of minutes here recently talking about funding strategies, level funded, self-funded, fully insured, and then that bundle unbundled. So consider evaluating or changing that funding mechanism or a bundled or moving to an unbundled arrangement. One resource that I would, say can help is a Health Rosetta plan grader. Health Rosetta is a nonprofit organization that has kind of tried to take on healthcare costs. And the founder, one of the co-founders, said that healthcare has stolen the American dream. And so he's been on almost a decade-long pursuit to try and find solutions. And as part of that, they've created this plan grader assessment that helps you evaluate what they've identified as the 8 primary components of a health plan. So you have your advisor relationship, which we moments ago were just talking about, making sure that you're having transparency, all the way through plan documents. This is how you're set up: level funded, fully insured, self-funded, to education, to primary care. We've talked about direct primary care, open networks. We've talked about networks, broad, open, and then that pharmacy benefits. So this is kind of a very nice assessment to evaluate where you're at. And then the questions alone kind of can help steer and navigate things to be considering. The second consideration with your upcoming renewal is to partner with a transparent pass-through pharmacy benefit manager. So this kind of inherently assumes that you're in an unbundled arrangement or considering moving to an unbundled arrangement where you have the option to shop that part of your health plan. And why would we want to do this? Here's just a quick conceptual model of what that space looks like today. I, in preparation for this and getting these couple of statistics, probably reviewed this chart 10 times to make sure I counted it all correctly, because there are arrows going every which direction and different arrows meaning different things. But I do think that I got this right, that those black boxes represent 7 different stakeholders, from the plan sponsor, the company, to the individual, you and I, to the pharmacy benefit manager. You can see our manufacturer, our wholesaler, and our pharmacy. There are 10 different flows of funds, meaning that's where money is being exchanged. And everything that's above this orange line is an area where there might be a shell game happening. So the payment to the pharmacy benefit manager seems like one of the most straightforward. But you can see here between the pharmacy benefit manager and the manufacturer, there's rebates at play. And while you might receive rebates today with your current pharmacy benefit manager, it might not be 100% of the pie. So there's percentages that can be lost in that. So just be cautious and wary. And that's why you want that transparent pass-through, where the ideal situation is where your pharmacy benefit manager is only receiving compensation through this payment right here, from the health plan to there. Everything else that happens to the top and to the right is 100% pass-through. Currently, the big 3 PBMs are CVS, Caremark, Express Scripts, and OptumRx. And so if you are with one of those as your pharmacy benefit manager, they have a lot of leverage. They have a lot of weight. And so it's at least worth knocking and asking some more questions in that space. And then the last thing I would say is, and the tip is, to leverage a pharmacy benefit expert, because there is nitty-gritty details in these multiple page contracts. And to summarize it all, understand it all, an expert, subject matter expert, which I am not one, to say the least, would be worth the investment. The last suggestion or consideration is what's called an alternative health plan. And kind of the foundation of this is built around innovation. So as we can see here, the music industry over the last handful plus decades has evolved. We had cassette tapes that became 8 tracks, that became CDs, that became MP3s, and now we're on a cloud basis. You contrast that with the health insurance industry, where in the 1980s we had the PPO network interjected, and we're still operating on PPO plans today. And so there's, as of now, there's 3 companies that are entered the market in the last couple of years that are creating what they're deeming alternative health plans. These alternative health plans are very tech-based, and it's also these health plans kind of talking about our education bit when we said that only 4% of Americans know deductible, co-insurance, co-pay, and out-of-pocket maximum. They've eliminated two of those terms, and they've simplified what the plan is to a copay and to an out-of-pocket maximum. And so the way it kind of operates, and we're looking at a screenshot here of one of those different companies, and again, those are called Simple Pay, Toop, and Surest. So be looking those up. But the concept is me on my phone, I would look up where I'm at, type in my zip code, say I need to, my wife is going to have a baby, and this shows you the copays of what that would cost me to have a baby. This is a very interesting one because, pregnancies are multiple months long. There's multiple visits and ultrasounds and then delivery. What you're seeing here is a cash price, a bundled copay price. So and that's the entire treatment of care from first appointment all the way to delivery, whether that's natural or cesarean. And so you can see it's giving me on the front end this information, kind of talking about the price discrepancy that we had of where should I go. If I go to Nebraska Medical Center, it would cost me $1,300. If I were to go in, this would be the location at South 144th, because we also have a Nebraska Medical Center down here that is at a different location, and that's a different cost. And then you have Bellevue down here at $2,000. You have a Methodist Hospital out here at $2,350. So it's giving you, the consumer, information before purchasing any care of what it's going to cost you. So like I said, we've eliminated deductibles, we've eliminated coinsurance, and now you're helping make informed decisions on the front end. The two things how are they doing this? There's a lot of data, there's a lot of technology, but the primary indicators is what is the cost, so that they take into consideration cost and then quality. Because sometimes quality might cost a little bit more, but if there aren't readmittance rates or complications downstream, you just get to save on that side of things. So very innovative leaning, and so wanted to make sure that you guys are getting a little taste of what's out there and what's coming and options there. So just to kind of land the plane, those three considerations are, number one, consider changing your funding strategy or move to a unbundled arrangement. Drill into that pharmacy benefit manager. Another thing I didn't say on that slide, but RX costs continue to grow and grow. So, 15 years ago, RX cost was, 12 to 15% of total health spend. Now it's north of 20, if not 25, 30%. So it's continuing to increase as a more prevalent consideration of that budget. And then the last is consider exploring an alternative health plan.
Thank you, Ty. A couple really quick questions here. So one member asks, for self-funded options, I believe they're in self-funded, we need the best consultants and TPAs that are very proactive on cost containment measures. What organizations are on the leading edge in this realm? Yeah,
great question. I would say on the independent TPA side, there's a handful out there. Edison Healthcare, Lucent is out there, Allied Benefits. Again, there's a lot of TPAs in the space, and you definitely want to find that partnership. Again, your broker advisor should be helping bring those solutions to you to vet and explore.
And then what are the names of the existing alternative health plans to look up that you said?
Yeah, I'm kind of regional in the Midwest here, so I have a little bit better pulse on some of those. There's one in one in Kansas City, Missouri, and then the other one in St. Louis that I'm aware of, and more are getting built up. But Creative Benefit Consultants is one that has a great program out there that's unbundled, and then Level Funded Plans out of St. Louis is another one.
What a novel idea. I mean, let's give people pricing on the front end so then they can choose the choice that best meets their needs. But and then another question, somebody asked, thoughts on adding a Garner or similar to plan management for team members?
Yeah, Garner's kind of in that similar light of that alternative health plan. It's not a health plan, but it's giving members upfront information on their phones to search out providers, and then there's incentives tied to that. Correct, to say, hey, if I go to this doctor because it's been evaluated as a top performer, then there's reimbursement to that. So that's another great solution that's in the space. And again, anything we can do to help members, you and I, as we engage the system, empower them with information on the front end. And again, Garner, the Surest, Coop, Simple Pay, they're helping navigate, which is a great resource.
Sounds good. Ty, do you have your contact information on that last slide?
I do, yeah.
They just flip there, but Ty, I just want to say thank you for being on this call and helping demystify health insurance for us. I know it's a very complex topic, and just really appreciate that. We'll send this slide deck out and the recording of this to everybody. So if you did not get a question answered that you have, feel free to reach out to Ty. I know he'd be very happy to answer that for you. And again, we want this to be educational for you. And hope you enjoy the rest of your summer, and look forward to talking with you again soon. Thanks again. Take care.
Bye-bye.